Simply the words passive income, okay, is enough to make you want it, right? I don't need to work. There's a bunch of mailbox money coming in, and that sounds great. Listen, most people, passive income should play absolutely no role until a later date. Let me explain in this video. My name is Walker Dybel. I am the Wall Street Journal bestselling author of Buy Then Build, creator of Acquisition Lab. I have acquired 8 companies outright. I started a private equity company earlier this year. I've raised millions of dollars. I've been a professional investor in the private markets for 10 years, et cetera, et cetera. Listen, the thing is like the reason why we're attracted to passive income is because, we hear that, what we hear is financial independence. Okay. So what financial independence is that point in time where you have enough passive income coming in, income that you're not actually having to spend your time to achieve. Okay, and that you can actually support your life. Okay, it meets or exceeds the expenses of your lifestyle. That is financial independence, and the thing that makes passive investing so cool and fun, right? But let's talk about first the ways in which we approach passive income. So most commonly, okay, are going to be sort of like public tools such as bonds, dividend stocks, things like this, like REITs, things that you can just go buy in the public market. And, these are going to be like sort of lower income based things that are sort of, higher security or whatever. They're the most common, the most accessible. Okay. And the returns tend to be low enough, unless you're in a total dividend strategy, the returns tend to be low enough that people who are have access to this will typically do 60-40 split, so they'll do 60% stocks just to increase the accumulation on these because they're so much lower. Now, if you look at the private market, okay, what you get is credit funds, and really real estate, and usually syndications. Let me explain. So credit funds are basically in every deal you've got equity and you have debt. And the private market debt tends to be senior secured and have higher interest rates of maybe like a 9 to 14% cash on cash return. Okay, what that means is it's like every year, usually paid quarterly. You take, let's just say 12% for whatever. So you'll get 3% of whatever your investment is every quarter. You put in 100,000, you get out 3,000 every single quarter while your money's in there, and then when you pull it out, you get exactly what your money was. There's no multiple on equity after. So it's really just taking the debt side of private debt and being on the credit side of that debt so that you can generate income. It's significantly higher than bonds or dividend stocks, for example. Real estate. Look, there are ways to engineer passive real estate that you own. Okay. Maybe you own an Airbnb and you don't manage it. Maybe you own a multifamily and you don't manage it. I think that the key here is to understand that, if you own, 200 doors of privately held real estate, that's a business, okay? If you're not active in it, it's because you have your team, but you're still going to be active in it to some degree, okay? That's a business, and you've chosen real estate as your business that you own, which is great. But that's not what we're talking about here. We'll talk about buying businesses and running businesses in a minute. In the meantime, the single best way to get passive, okay, real estate investment is through syndications, in my opinion, okay? And you may have seen, my video on fractional acquisitions. I talk a lot about private credit, private real estate, private business transactions, equity. And so the real estate syndication is that side. Now, when you're looking at a real estate syndication, okay, usually, you're going to get something like, okay, they're going to sell you something like, okay, put it in this vehicle. Usually there's a short period of time where there's no cash flow coming out. Maybe it's even a year or 3 or whatever. But then the thing is like ultimately what we're trying to get to is usually like a 8%, cash on cash return. I put in $100,000, I'm getting $8,000 back every year. I'm doing nothing, okay? But the thing that makes it a great investment is actually the equity multiple, the sort of kicker at the end. So usually around, your 3 through 7 somewhere, there's sort of like a, let's call it 1.5 times or, 2 times equity multiple. What that means is I put 100,000 in, I get $8,000 every year until that syndication is closed and we exit the property, in which case I'm going to make either $150,000 or $200,000. Okay. And, the thing is that I'm trying to push here, when it comes to investing for the long term, even the middle term, what you want to be doing is reinvesting your dividends. Okay. All of us who understand compounded interest in the stock market know, when you're in your 20s, when you're in your 30s, when you're in your 40s, it's all about like just reinvest dividends, like just, keep the dividends reinvesting, because that's that compounded growth that, Albert Einstein is, credited as saying like it's the eighth wonder of the world or whatever. But I think that quote is wrong, but that's neither here nor there. Or I don't think it's from him, is my point. So the point is like $8,000 a year is great. It's great. But the thing is like you can't quit your job on $8,000 a year. Okay, if you're watching this video, you can't quit your job on $8,000 a year. So you need a significant, amount of money, to plug into passive income in order to actually create the financial independence that you're trying to get. Sure, this is piecing away at it, but the trick is the real juice of this investment is going to be on that accumulation component that's coming. It's nice that there's some cash coming in, but like you've got to reinvest that, and you can't find another private investment for $8,000. You're just not going to be able to find it. So by the time this is selling in 5 years, you now have just accumulated enough for like a minimum private market investment on the $8,000, right? Plus you got to pay taxes on it and all the rest, because you can't buy something for $8,000 and do a cash flowing thing for $8,000 and do a section 179. So you're going to be paying taxes on the $8,000 now, and that's going to diminish all of it. So there's two sort of ways that we sort of think about these private investments, and buying businesses, which we'll get to in a minute. And the first that I want to talk about, there's more to it, don't get critical, but there's two that I want to kind of highlight to make this point, The first is cash on cash return, and the other is the internal rate of return, Now, the cash on cash return simply points to how much cash am I getting every single year on my investment, So in the credit funds example, I was getting, 12%, In the syndication example, I was getting 8%, And, if you have like a patient capital, where it's going for accumulation only, your cash on cash is going to be 0. Talk about that in a second. The other is going to be IRR, your internal rate of return. So on the credit funds, it's interesting. You're getting a 12% cash on cash return, but let's say you decide to pull your $100,000 out in 5 years. That means that during that time that money was in there, it didn't actually accumulate to more, because you've been getting it all the way, all the time. It's been paying out to you. So when you live off of that 12%, for example, because it's passive income, then what's going to happen is you get your 100,000 back, but it didn't keep up with inflation. So your internal rate of return is actually only about 10%, even though it's been paying you 12. So again, it just comes back to, even in the credit fund example, you're going to need to reinvest all of that money to get you to a bigger number until you can live only off of these numbers, because your rate of return is declining. When it comes to these real estate syndications, what you're looking at is sort of like usually like a 14 to sort of 20% internal rate of return, which is great. It's great. That includes though the 8,000 that you're getting along the way. So you're either living off of it as passive income, or you're trying to reinvest it in something else. And so but because the money's coming back to you a little bit sooner, and you get that kicker at the end, you're able to increase this multiple. Now, when I look at patient capital investments, things that, so on the one hand, you can see a spectrum forming here, right? So on the one hand, you've got this sort of, cash on cash return, right? This income, we'll call it income. And then on the other side of this spectrum, you have like accumulation. And accumulation is maxed out. It's sort of like patient capital investments, right? These are the things where I say, look, I'm making an investment into this equity. I'm not expecting any cash on cash in the short term at all. It's really an accumulation play. I like to think about this as, the things that are out there that we can find are the sort of like 3 to 5x in 3 to 5 years, So, 400% growth in 4 years, or with a standard deviation on that, right? And then the income is sort of like, hey, you're going to pay me no money back, but like we're going to maximize the cash flow to me along the way, okay? Here's the point. If I want to be truly financially independent, okay, I have a number in mind. Now, I can get these real estate syndication deals all day long, okay? So as you're thinking about these real estate syndication deals at 8%, it's also growing in the background at a pretty decent rate. But when you're looking at accumulation, okay, the internal rate of return is going to be more like, depending on what happens, it's going to be more like 32 to 41%. So the point is, is that you don't need the passive income while you're in accumulation mode, because you need to be reinvesting all of it to be getting that balance sheet to the point that you can flip it all over to passive income. And so the truth is like, you can pick your private investments here. You can look at, a 10% IRR, but be getting cash. You can be looking at a 14 to 20% rate of return after, and after 4 years, that's what I got. I got, let's just call it 18%. Okay, I got 18%, or I got 10%, right? Or if you look at these accumulation plays, right, you're looking at, let's call it 35. I mean, that's ultimately what we're trying to get, 35% IRR. So you're accumulating significantly higher, almost like double, okay, off of the other second best option, okay? Of course, there's risks and being able to, understand business strategy and operational risk and all the rest of it. But these are the things that, build and accumulate faster so that you can actually reach that financial independence sooner and flip over to that passive income. Okay, now look, Walker, this is super great. But like, you wrote, buy, then build. Okay, you talk to us about buying existing companies all the time, right? So why are we talking about this? Well, okay, you maybe have seen my fractional acquisitions video. And the point is a lot of people come to me and they say, Walker, look, I want to do what you did. Okay, I want to buy like 8 companies, but I don't want to take, I don't want to buy one company for 7 years and then buy a whole bunch, in the few years after. What I want to do is just buy 8 companies like this quarter. That's not a good strategy. You're risk stacking like that. This is a high leverage, high responsibility business model. Okay, we don't need other cash from investors in order to play it. Okay, because it's all on us. It's all about having the growth mindset, getting in the Coliseum, getting the blood on our face and the dust on our hands and all that other stuff. It is a full court press game. Okay, it's a great one. It's the way that I made my first million. Okay, it's like you buy companies, you get in there, and then you've got this split. So let's use the same language we've been using, okay? If you're buying your own business, okay, and you're buying it like a 3 to 4 times, earnings on that business, which we talk about, it's high leverage. So you've got principal and interest payments going on, which would be an internal return because you're buying back your equity. But then you're also, it's the fastest way to sort of replace like a 6-figure salary, right? So you're able to take some money out and you're able to reinvest and pay down the principal and interest along the way. And what happens is, I love to say like, hey, 3 to 5 years and, sell it if you want. But like, you really need to build a lot of value if you're going to try to sell it in that short of a time period. Okay. And which is why no one likes working for private equity, side note. But the point is, if you do this model, you're going to need to keep it for more like 7 to 10 years. Okay. Or more, right? I mean, this could be your career business, right? I mean, if you're able to turn that thing into a cash cow, don't sell it, right? But the point is like, if you're buying it 3 to 4x, okay, 3 to 4 times that annual, sort of earnings, you're looking at, kind of a, 25 to, I wrote 35% internal rate of return plus your cash on cash. Okay, they are combined in these sorts of examples, okay, which is why I call it return on investment and buy then build, but whatever. The point is like, my target in these businesses, even if I'm buying here, I'm really, you're using inventory and working capital and all the rest. I mean, I'm always like the textbook is like try to get 35% or more okay, on your internal rate of return over the whole of these businesses, right? I think the second business I acquired anyway, I got a 52% compounded annual growth rate during the 4.5 years that I owned it. And that was just like sort of a buy then build textbook example. So the point is these are there, but like it takes all your time, all right? You've got to run a business, okay, to do this. And ultimately, if that's what we're trying to get, okay, if you can think of the number that you need, okay, to move to a passive income lifestyle. Let's just pretend for a minute, for easy math, we'll pick $280,000 a year. I would say most people in America, if they can't live off of $280,000 a year, support their family, they're probably living in, Los Angeles or, Malibu or Manhattan. But the point is like, most people should be able to do that. And unless they're just terrible with money. So the point is if you think about, okay, I want $280,000 like pre-tax, and then I'll do real estate syndications and get whatever and try to pay less taxes along the way and blah, blah, blah. And then I'll continue to accumulate in these sort of real estate syndications and all these other private market things. If you take that $280,000, okay, and you say, okay, you're going to divide by 8%, that's $3.5 million that you need to accumulate. And you might be saying to yourself, okay, well, how do I get $3.5 million, right? I mean, that's the next logical question, just working backwards. And the concept here is like, if you take 3.5, okay, and we are going to go for a full accumulation, sort of 35% IRR, 4x kind of targets, then what we need is, we need to, divide that 3.5 million by 4. And when we do that, we come up with $875,000. I'm going to round it up to $900,000, okay? So what I just spat out there in this video was, in order to get $280,000 in passive income, I need to first invest $900,000 in high IRR opportunities, okay, that are all going to 4x to get me to that 3.5 million that I need to put into real estate syndications and whatnot to cover that 280,000, okay? If these numbers are too big for you, subtract zeros. If they are too small for you, add zeros until it's interesting, okay? But here's the point. Now I need to come up with $900,000. How the hell am I going to do that, Walker? Okay, so here's what you're going to do. And this is why the wealth stack starts with, the foundation is you own a business, okay? And so I have done well through acquisition entrepreneurship. Obviously, I wrote the book on the subject. And so the concept here is, I want you to think to yourself, okay, I'm going to take that first 100,000, 100 to 300,000, whatever your numbers are. I'm going to go buy an existing company that I'm going to own and operate, okay? I'm going to build up equity in my business. I'm going to pay myself so that I can survive. I'm going to reinvest in the business, and then I'm going to try to find an extra $100,000 every single year, okay, for the next, in this case, 9 years, really 7 to 10 years. And then over that time, this is going to turn into 3.5 million. At that time, you'll be mature in your business acquisition, and you might be ready to sell it, okay? And your passive income investments will have stacked up to the point where you can flip over to a passive income strategy and be financially independent. So this is the, I'm going to get, really rich in the next, decade kind of plan. But, I think the concept here is that working towards passive income right away, okay, doesn't really make a big impact. And so the way that I've always thought about it is, how can I stack the higher IRR returns over 4-year periods of time so that I can get to, the whatever your number is, faster. It's the most direct route, okay, between where you are today and where you're trying to get to financial independence, all right? So listen, accumulate before you cash flow is kind of the point. And, if you've been getting my emails, then you know that in our private equity company, we've had one of these opportunities that we recently took out, formed an SPV. But the point is like, the way that this game gets rolling, okay, you need to be able to be bringing in money so that you can make these investments and sort of scale and diversify your private portfolio, your private market portfolio. And the way we do that is by buying existing companies, all right? After I wrote Buy Then Build, we formed Acquisition Lab. We anchored in world-class education. I hired a curriculum designer, okay? And I taught the curriculum at a ranked MBA program for 2 semesters before we opened it up. Today, we have the single largest vetted, active, armed with cash buyer community in the world. Okay, it's a vetted community. We have 14 advisors on staff. We've got Slack channel, 6 coaching calls a week. I run the search forum every other week. We've got an intensive where we spend a lot of time getting everybody up to speed on the silver bullet broker communications, all of the tools, all of the models that we use, and how to succeed in going out and acquiring a small business. Check it out at acquisitionlab.com. We'd love to meet you, and we'll see you on the inside.